Hi, welcome to StatStuff. I'm Matt Hansen. In this lesson, we're going to review how you can identify and categorize the financial benefits from a project. There's one prerequisite for this module, and that's the lesson on corporate CTQ drill down. Some information in this module will be referencing some of the concepts from that other lesson, so you may find it helpful to review that other lesson first. Let's begin by exploring the concepts of financial savings and how it applies to a business.
Well, first of all, financial savings must be reported accurately. They serve as a measurement of a success for our projects and the business areas that we're supporting, as well as a measurement of success for the contribution that we're making to the company's profitability, which, for example, is like the Level 1 CTQ of financial performance, as we went over in another lesson on the CTQ drill down. Financial savings also serve as a decision tool for helping us to determine, is the project worth even continuing? In other words, are the savings really there as we originally expected, and should we just cancel this project if the savings aren't there? As well, it's a way for us to prioritize opportunities or projects within the business, because we can determine, based off of the financial savings that we'd expect from a project, whether it should get top priority or maybe reduce the level of priority. It's also a gauge for our sponsors and champions, where they can use that information from a financial perspective to enforce accountability to their own budget or the resources that they manage, as well as a way for them to brag to their other executive leadership about the goals that they're achieving. Financial savings must also be reported consistently. It adds credibility to your time and effort in successfully leading a project, as well as it helps build a common language for how we can communicate savings. In other words, if you have different departments achieving different successes on different projects, financial savings is a great way to have a common language of the contribution each of those different areas are adding to the business, other than using specific metrics that are really unique to their own department. Financial savings is a great way to normalize those kinds of savings that they're contributing to the business.
Let's apply this to the concept of return on investment, or ROI.
Well, for financial savings, we can say it all basically comes back down to ROI, or return on investment. So let's explore that a little bit further. Every project has some sort of financial cost or investment toward it. So you have to be aware that there are probably some lurking indirect costs. Some of those direct costs are pretty obvious, but the indirect costs may not be. For example, if there's cost for training or cost to implement safety or policy types of issues, be aware of those indirect costs that are really there and lurking behind the scenes that you may not be aware of. Also, every successful project will have some sort of savings or some sort of return. Now, savings may not be financially measurable, so that might actually create a negative ROI. So it's critical that we at least understand the type of savings or return that we're getting for a particular project or initiative that we're working. So it's really critical that we try to estimate the potential ROI as early as we can within the project. Now, there are two primary goals for when we're working with ROI. Basically, it comes down to calculating or communicating the ROI. So the first goal, calculating the ROI, basically it's determining what's important to the business. What are those CTQs that are important to the sponsor that we're using to measure success? As well, measuring the return or the potential or actual project improvements that we're working on. As well, measuring the investment on the required cost for implementing those improvements. Again, getting a true picture of what the ROI is for that opportunity we're working. And secondly, we said that the second goal was to communicate the ROI. That is, using financial terms, for example, that the business really understands, speaking their language, using their metrics and translating that to a financial perspective. And also using some visual displays that simplify some complex concepts or complex logic that was used to calculate the ROI. But we can do it simplistically, again, using the language and terms and visuals that is relevant to the organization that we're trying to improve. And as well, if we can, try to get a subject matter expert in finance or a SME in finance who can help validate our financial savings.
Some organizations follow a formal process for validating financial savings in the business.
So what I want to try to walk through here is an example of a formal process that might be used for validating savings with a finance group, and this might be for an organization that has a larger Lean and Six Sigma type of program, and when you have a project that runs through the program, like through a DMAIC methodology through the program, then this might be an example of how you might go through the validation process with finance. So in this example, basically you'd have three separate swim lanes in here representing 3 different groups: finance, the sponsor of a project, and the black belt themselves. And if you can see, as far as the columns across the top, I'm going to use my mouse to kind of move and point this. It starts with the selection of the project, moving on to the define phase of the project, then to the improve phase of the project, and then to the control final phase of the DMAIC project. Obviously skipping a couple steps or phases within DMAIC simply to show that at those other points it's not as necessary to validate with finance, but these are the points within a project that you might want to validate with finance. So it starts in the selection piece here, where you're exploring a project opportunity. Then you're trying to get the high-level estimate of benefits with your sponsor, and you want to validate with finance. That represents maybe the first gate of approval with the finance group. Then as you begin the project and they select it, then that black belt will basically run through the project itself, and they'll complete the define phase. And again, at that point, as they explore the opportunity, have a better handle on the size of the problem and the project itself, then they'll want to confirm those high-level benefits again with the sponsor and get that validated with finance. And they'll basically start to build a case for forecasting the potential benefits that could come from this project. Then as the project progresses, you go through the measure and analyze phase, and then when they finally get through the improve phase, you've certainly identified what the actual improvements are to the project. You have a much better idea of the benefits you can expect from those improvements. And again, you want to go through another pass with the finance group to get it validated so they can update those benefits in their forecast for the budget. Finally, when you complete the project where you've already implemented the improvements, now is the time that you can confirm the actual benefits with your sponsor, as well as getting those benefits validated by a finance person. So that way you can lock in the savings, and you've got the backing of not only your sponsor over the project, but a separate third-party group from finance who can validate, yes, you were able to contribute these savings to the business, and it was able to be added to the budget itself, where you're making an improvement to the bottom line.
Now let's discuss 4 different categories for financial savings and how you can determine which category your potential savings may fall into.
This particular discussion now on savings categories is what I believe one of the most critical aspects of financial savings in this entire lesson. It's important to me because I've noticed in many different projects, the savings that are represented for the different projects are not always the same types of savings. In other words, $1 million saved in one project versus a second project that also claims to save $1 million isn't always the exact same types of millions of dollars that we're talking about. They may be different types of savings, where one makes a direct impact to cash to the bottom line of the business and the other one doesn't. It's more of what's sometimes called a soft savings. So what I'm going to go over in this part of the lesson is a categorization of the different types of savings that I think is really essential for us as we try to quantify and qualify our financial savings. So basically I think it would break down to 4 separate categories illustrated in this particular metrics. So let's take this down one by one here. First, we'll start with direct tangible types of savings. These are the types of savings that have a direct impact to cash and also a direct impact or tangible impact to the business, or maybe what might be a tangible in the sense of a measurable impact to the business. So these are actual dollars that impact cash flow. So the examples that are given in this particular box would be something like increasing revenue, or reducing existing costs that we have, or reducing headcount, or reducing overtime. Now another category on here is indirect tangible. These are things that are making an indirect impact to cash, but they're still tangible and measurable to the business. So it's a measurable, but not necessarily an impact to our cash flow. So the examples here are shifting headcount. We're not really reducing headcount, but we save some time and labor for what our existing employees are doing, but now they're doing something different. We didn't really eliminate them, so we didn't reduce any payroll off of our operating expenses, but now they're doing different types of work. Well, that's really shifting our head count. So it's, again, not impacting the bottom line, but it does still make an immeasurable impact to the business. Or another one is accelerating their existing cash flow. In other words, we might be expected to get a certain level of cash, like our accounts receivable that show up on our balance sheet. Well, the cash is already dedicated and the customer is obligated to pay us, and it's recorded on the accounts receivable. But if we can get that cash faster, well, that's a good thing, because we can have more access to the cash now. But it doesn't mean we're getting more cash than usual. We're just getting it a little bit faster. So in that way, again, it's not adding new or taking away cash from the bottom line, but it still has some measurable impact to the business. Third category might be direct intangible. That is, it's having a direct impact to cash, but not necessarily measurable or tangible to the business. So they're actual dollars that could have impacted cash flow. For example, avoiding lost revenue or avoiding additional costs. For example, if we haven't done some particular activity or had better control or maintenance over some of our assets, if we didn't do that, we could have lost this additional revenue, or we could have incurred these additional fees or penalties if we didn't do this. Well, the fact that we have prevented lost cash or prevented lost revenue, in that way it does have some direct impact to cash, but it's not necessarily tangible because we don't know if it would have really happened. So we might have given it a little bit lower priority. And the last group is something that's indirect and intangible, and that is, it's something that's not quantifiable in dollars, but it still adds some sort of value to the business. So we can't tie it necessarily to the bottom line, and it may not be measurable, but we know it's something that's still valuable and necessary to the business. So some examples here is maybe compliance issues, or customer satisfaction, or employee satisfaction. Some people may argue that you can tie, for example, customer satisfaction to something measurable to the business. Quite honestly, customer satisfaction is generally just a perception. If you can directly correlate satisfaction by the customer to actual revenue coming in, well, then you might shift that to be a category 1, a direct, tangible type of savings opportunity. But generally, when you're talking about satisfaction or perception, it's a lot harder to measure and a lot harder to tie a correlation to cash to the business. So how do we determine when we have different types of financial savings in a particular project or initiative that we're working? How do we determine the types of savings category that it might fall into? Well, I think there are two basic questions that we can ask ourselves to figure it out. First of all, does the project affect cash flow? For example, is it increasing revenue or decreasing costs in some way? If it is, then it would be a direct savings. If it's not, then it would be indirect. That would determine which column it would fall in. Again, it would be either direct if it is increasing revenue or decreasing costs, and if it's not doing either of those, then it would fall to the right column, which is an indirect type of savings. The second question would basically be, does the project have a financially measurable improvement to the business? So if you can't measure it to the business, then it's probably going to be an intangible savings that would fall into the lower row of that matrix. Otherwise, if it is tangible, something that you can measure for the business, even though it may not be something realized in cash, that's okay. But if it's something you still can measure, for example, again, you've reduced the workload for certain employees and now you've shifted the responsibilities for those employees to something different, even though you didn't take those people off the payroll, now you have different work that they're doing because you've saved them time in other areas. And you can still measure that and it still has some tangible savings, so that might still fall in that upper tangible row. So those are the kinds of things that I believe that you would need to ask in order to figure out the type of savings that your particular project or initiative that you're working would fall into.
You're probably thinking this is all easier said than done. Well, that may be true. So let's explore how you can find and calculate your financial savings.
Well, finding the financial savings in a project can be a bit challenging, so I'm going to walk through several steps and give you several tips that might help you in trying to find that financial savings and calculating it. So basically, I'd recommend starting off with converting your project Y to cash. Now, when I say project Y, that's generally using a term from the Six Sigma side, where we'll get into a lot more explanation of how you define your project Y and that sort of thing in many of the Six Sigma lessons. However, for argument's sake right now, we'll just say project Y refers to the measurable output, or your primary CTQ, or whatever you're using to measure success for your particular project or initiative that you're working. What is that key metric you're using, and try to convert that metric in some way to cash. So also, how does that project Y, how does that metric affect cash? That is, as far as, does it increase revenue in some way, or does it also decrease costs in some way? And are there any other measurements that could be used to help affect cash that you can account for, even though it may not be the project Y itself? And I would also try to explore how your project Y, that metric, will benefit other groups, like stakeholders who are upstream from you or those who are downstream from you. So don't just think about how you have to measure it when your specific area where you are. It might be a great improvement for your area, but that improvement could have even better, more cash impacting effects to another group as well. So be sure you account for those as well and you don't exclude them. The next thing then is to define the equation that you would use for converting that key metric or the project Y to cash. If it's a complex equation, I definitely recommend mapping out the flow of logic you're using to calculate it, maybe in Excel or something like that. And if you're using labor hours to calculate costs, be sure you get with your finance folks so that you account for the particular fringe benefits factor that they use for calculating labor. In other words, don't just use the direct labor rates for the people that might be affected in the improvement that you're implementing, because there might be some additional factor used by your finance group to account for additional benefits. And they might have a different factor for whether you're talking about hourly employees or salary employees, or depending on the level of benefits that they have. So be sure you connect with your finance person to find out what factor they recommend you use. As well, remember that the savings for the salary employees are a lot less likely to affect cash unless it's through a headcount reduction. In other words, if you're just going to change the labor or the work activity for folks that are salary employees, they're not getting overtime. So because they're not getting overtime, you're not going to have as much impact to cash unless you're actually cutting heads and reducing the headcount for them. Versus someone who is a contractor or someone who is getting paid hourly, where you're going to reduce those hours, or you're reducing overtime, or you're cutting out some of the rate or hourly amount paid to contractors. That generally has a more direct impact to cash than if you're talking about salary employees. So be sure you account for that. As well, if you're talking about savings that are from reserve accounts, for example, reserves for write-offs or reserves for workers' compensation, those are not always affecting cash directly, so be careful of those. You can't just take those as a direct impact to cash, because with reserves, it's just the accounting method for accounting for these types of write-offs or workers' compensation, so you're not necessarily bringing more cash in or stopping the flow of cash going out of the business. So make sure you account for that as well. And get with your finance person if you're not sure how to do that, if you have those types of savings opportunities. The next big thing would be to calculate the savings using an equation. The equation that you just built, then actually calculate what that savings would be. I'd recommend normalizing each factor that you're using in the equation. So what I mean is, for example, if you're using a project where you're trying to reduce the past due revenue, well, if you happen to see some measurement, you're trying to measure the past due revenue, that is the revenue that is past due where the customer is not paying you timely, then if you're trying to measure that and you see some reduction over time, you might think, hey, that's great. But for all you know, the revenue is also declining too. So it might be better to normalize it by using some percentage, like dividing the past due revenue into the total revenue, so you get some sort of past due revenue rate. And you can see over time, is the rate decreasing like you hope it would be. And so that way, if the revenue does decline over time, then you can still have a normalized rate to account for that. Also, for annualizing your predicted savings, I recommend that you do try to annualize it, but you have to take a couple things into consideration. First, drill down the potential savings to the lowest level in time, like if you're going to get down to hours or days or weeks, some reasonable level that makes sense. But whatever that level is, then make sure you multiply that out over a year in order to get the annualized rate. Now, if the cash savings happens to be known for a less period of time, in other words, you know that the savings that you're going to expect is only for less than a year, like a 6-month time period, then you're obviously not going to need to annualize it. You'd only account for that actual time that you know the savings will be realized. But conversely, if you know your savings are something that's going to grow over time, or it's going to be realized more extensively over a longer period of time, then you may find yourself needing to use some sort of annual average to account for the additional savings you can expect over multiple years. So whatever way you use, no matter how you calculate this and what you're using, make sure you validate your savings with your team and validate it with someone from a finance perspective, preferably a third party who can look at the savings, look at the opportunities that you have, and validate the method you're using for calculating those savings, and making sure you're identifying the right category and the right equation for calculating those savings to make sure that they're practical.
Let's review how financial savings were calculated for a couple of example projects. One is focusing on improving the efficiency of handling write-offs, and the other on the efficiency for improving timeliness.
This first example is for a project that I worked where we're trying to reduce the amount of time spent in handling write-offs. So basically the project goal was to try to streamline this collections team that was spending 18,000 hours a year in trying to work through a manual process of reviewing the past due bills to figure out which ones they need to write off. So it's really a lean type of project. So as far as the results from the project, what we did is we illustrated this using an as-is and to-be process map to show the savings opportunity. So first we illustrated here that there were 4 separate groups illustrated by the 4 different columns or swim lanes, and this is the actual process that they were generally following. And we marked an X just to illustrate visually here what steps we were able to eliminate. And then we just showed here this is how we can streamline it from what was the as-is to now this much more streamlined to-be process. So regardless of what was involved with actually the project itself, from a financial savings perspective, we built this basic savings equation here where we said the equation is taking the bill volume per month, multiplying it by the employee time per bill times the labor cost involved, and multiplying that out by 12 months to annualize it. So the actual savings that we illustrated is here over onto the right hand side, where we broke it down between the collector and the collections managers, and we had to separate them because they did have different amounts of hours that were spent, but at the same time they also had different hourly rates and different labor fringe benefit factors that we had received from finance, and all these rates were validated for us from a finance group. And basically this is our method for how we built this in Excel, using this more complex equation to figure out the total savings we contributed to the organization. So basically, to summarize the savings that we had here, we basically said that, you know what, by minimizing or streamlining this entire process, they really didn't reduce any headcount. So since there was no headcount reduction, the $258,000 savings that we saw per year was an indirect tangible type of savings. That is a category 2 savings, where we didn't make a direct impact to the bottom line because the headcount wasn't reduced. We just shifted their workload to now do things that they couldn't handle before. Now they're doing different types of work now that the process was streamlined. But it was still something tangible, measurable, because we can prove out that we were able to streamline the savings. We can measure it through the hours that we contributed. So we called it a category type 2 of savings. Well, the second example is a project I worked where we were trying to find the optimal time to invoice the customers in a way that would help us to get our cash payments from the customers faster. So the project goal was basically a way to reduce the days sales outstanding, or DSO, which is a general term in the business for measuring how long our cash is outstanding, how long it's sitting in accounts receivable before we can get it back. So we're trying to optimize across 4 different operating companies that this organization had, and how soon we can send an invoice out and ensure it's as accurate as possible. And the soonest we can send it out, that just means we can get our payments that much faster from the customer. By getting payments faster from the customer, we're getting the cash faster from the customer. So the ultimate goal was try to accelerate the cash received by the customer. So basically the results of the project, the way we tried to communicate it was illustrating this visual way where the savings were illustrated over time, where we showed above this particular timeline here, the as-is was we had a particular bill date that was at day 0, and then we just showed way across the timeline, generally off to the far right, the estimated time that we were getting a payment from the customer was anywhere from 38 to 42 days from the bill date. But under the new optimized invoicing time that we found, we're able to invoice sooner, and the average rate of getting that billed sooner and then ultimately getting our money sooner equated to getting our payment between 34 and 38 days from the bill date. So that just made for us a much faster way, of at least 4 days faster, that we're getting our cash. And it does make a big difference when you're talking about millions of dollars. So the savings equation itself was extremely complex because, again, we're dealing with 4 different operating companies and lots of variables that I wouldn't have time to illustrate in here. But basically just found that we had to filter down to find only the revenue that would potentially be impacted by the particular invoice timeliness in here. Because we're talking with different organizations and different types of revenue that were being affected, there was a lot of complexity in the different ways that this was going to be affecting cash. So we had to first filter down to that. Then we had to drill down to the different types of ways that we even invoice the customer. Sometimes it was by paper, sometimes it was electronically through EDI, and because of that, it had an impact on how soon we can invoice them and how soon those types of customers were paying us. We had to account for those factors as well. And then by having that information, we're able to calculate the total impact that we can expect for each cycle time reduction and how that has on the revenue and DSO as well as the debt and capital savings. In other words, by getting this cash faster, we're able to see from there not just the impact it has from a DSO perspective and getting that cash faster, but by having the cash sooner, then we can see, well, now that we have the cash now, what can we do with it? We can use this, we can now begin to pay down maybe existing debt or be able to make additional capital investments that we can now do 4 days earlier than we expected. And how does that translate to cash? So that's basically how we had to factor our savings. So basically, to summarize the savings that we realized in this particular project, we accelerated the cash by about $37 million in indirect tangible, which is category 2 types of savings. That basically means about $37 million a year is what we accounted for the amount of that 4 days sooner and getting that cash sooner affected. But again, it's indirect tangible in the sense that it's cash we're already getting from the customer, but we're just getting it sooner from the customer. So it's not any more cash we're adding to the business, and it's not less cash going out from that perspective. So we first measured it in that way. Basically, again, the category 2 type of savings of indirect tangible savings. But then we saw, again, there was an impact that we can have in trying to reduce our financial debt, like interest on our debt, or having a cost for capital, because now we can make investments sooner. And from our finance guys, they were able to evaluate for us that was about a 10% impact. So basically 10% of the $37 million, which is about $3.7 million a year, is how much we can realize in actual cash, actual bottom line cash. So that's what we equated as the direct tangible types of savings, or the category 1 type of savings to the business. So this is where I say that for not all savings are created equal. We have to be really careful in how we categorize our savings to make sure we're really comparing apples to apples when we communicate through financial savings that a project would have. So that way we're being fair and representing whether it's making a real direct impact to the bottom line of the business or just merely having a softer impact where it's not as big of an impact from a cash perspective.
All right, before we close this lesson, let's discuss how we can apply some of these concepts in a practical way.
Well, first of all, I'd like to know, how does the categorization of the financial savings that we discussed in this lesson, how does it differ from the typical approach that you might be used to, at least within your organization? And what do you think are the advantages or maybe the disadvantages of the method that we described in this particular module? Now, what I'd like you to do as far as from a practical perspective is now identify maybe 3 to 5 different projects in your area, ones that you were maybe a part of or ones that you led, where you had some sort of financial savings that were reported on them. And I want you to try to ask maybe these next few questions about those 3 to 5 different projects or initiatives. So first of all, what were the financial savings that were reported for those projects? And how were those financial savings treated by the company? In other words, did the organization use the financial savings that were reported to actually reduce the budget or make actual changes in how they operate based off of the expected outcome from that, or expected financial savings outcome from that project? And also, how would you categorize the savings from those projects based on the method that we described in this particular lesson? In other words, would you describe it as a category 1, 2, 3, or 4 type of savings? Again, back to the direct tangible or indirect tangible, that sort of thing. How would you categorize those types of savings for those projects? And for any of those, for those projects where you would say it's not a direct tangible savings, not that category 1 type of savings, then if you had done this type of savings categorization up front, how would that have affected the outcome for each project? In other words, if there's a particular project where maybe you claimed X millions of dollars in savings, but you found through learning these different categories in this particular lesson that maybe you would only call it a category 3 type of savings. If you had known that up front before even the project began, would that have changed whether you did the project or not, now that you know it wasn't necessarily something that was affecting the bottom line for the organization?
Well, that wraps up this lesson. Check out StatStuff.com for many more resources that can help you achieve powerful results. I'm Matt Hansen. Thanks for watching.